Palantir sends its own engineers to move in with its customers, factory floors, hospital wards, bank back offices, command posts inside classified networks. No other software company does this. It is slow, expensive, and almost impossible to scale. In July, Microsoft committed $2.5 billion and 6,000 people to doing it anyway. So this video answers two things: what Palantir actually sells and what that is worth. Its software sits underneath the artificial intelligence work at large companies and inside government, and its revenue grows faster than almost anything at its size. It also trades at about 150 times earnings, which is the number everybody quotes to tell you it is too expensive. Hold that number. The answer at the end is not the one you are expecting. First, take the case against it seriously. A price-to-earnings ratio tells you how many dollars you pay for each dollar of yearly profit. Most large American companies trade at a small fraction of 150. Pay that much and almost nothing has to go wrong for the outcome to be bad. That is the case, and it sounds airtight. But here is what it quietly gets wrong. A price-to-earnings ratio is not an input to a valuation. It is an output. What falls out at the end, after somebody has already decided how fast profit will grow. So every argument about this stock is really an argument about one number. You are not picking a company. You are picking a growth rate. And that does not get answered with arithmetic. It gets answered by what this company sells and whether anybody can take it away. So start where every product starts. The hardest part of building anything is not the building. It is finding the point where people want it. That point has a name: product market fit. If getting users feels like dragging them through a door, the product is not touching a real pain. Not weak marketing. Wrong product. When something does hit one, the opposite happens. Nobody was persuaded to use ChatGPT. Nobody was talked into WhatsApp, which reached hundreds of millions of people on almost no advertising. So the real question is not whether Palantir looks expensive. It is whether it has reached that point and how recently. Look at when that happened here. In April of 2023, Palantir released its artificial intelligence platform, then did something unusual. Instead of selling harder, it ran boot camps. A customer brings real data and builds something working within days. More than 500 ran in the first year across more than 460 organizations. That is not a sales pipeline. That is a queue. The stock went from under $8 that year to a record above $200. Hold on to that. It matters later. Now, the honest part. Plenty of serious people studied this company in 2024, with the stock in the low teens, and could not make sense of it. The filings were public. It still did not click. It is very hard to see the value of a middle layer until you have needed one. Consider someone who keeps their artificial intelligence memory as plain files, not inside one company's product. Fussy until you ask why. The model underneath can be swapped tomorrow, and the memory does not move. Or running a model on your own hardware on genetic data from a medical test. That data should never leave the building. Maybe one individual in 1,000 thinks that way. Then ask the same about companies. Almost every one. That is the case in one line. Rare among people, close to universal among organizations. So what does that layer do? A large company keeps its records in dozens of separate systems. One knows the customer, another the order, a third the truck carrying it. None use the same names for the same things. So one customer exists in 9 systems as 9 different things. No machine can reason across that. Palantir software, which it calls the Ontology, ties those records back to a single identity. One customer becomes one customer everywhere. What that produces is worth naming. A digital twin of the company, not a diagram. A working model of how the business runs, kept live. And this decides everything else. A model on its own knows language. It does not know your company. Ask the best model in the world which of your trucks is running late, and it has nothing to answer with. Hand it the twin, and it sees the order, the truck, the driver, and the delay together. The model is the engine. The twin is the road. In defense, the same twin supports planning while a situation is still moving. The machine lays out the options. A human still presses the button. So Palantir is not selling a tool. It is trying to be the operating system an organization runs on. Management say they intend it to be the operating system for the West. So the obvious question is, who else can do this? Nearly every Western company and government eventually needs a layer like this, though it has a hard edge. China and other non-Western blocs will not buy it because it touches data sovereignty and national infrastructure. Enormous and bounded. Now the competition, named plainly. Databricks, Snowflake, Microsoft Fabric, and Alteryx compete for parts of this work. Then the model companies, and here the comfortable version of this argument falls apart. The easy story says they stay in their own lane. That stopped being true this year. That Microsoft number from the opening was not an outlier. In June, Amazon had already put $1 billion into a unit of its own. OpenAI and Anthropic are both hiring forward deployed engineers too, whole teams. 4 of the largest companies in technology, in 1 quarter, all moving the same way. And the Microsoft version is deliberately model neutral, which is precisely the argument Palantir has been making for itself. 2 things stand in the way, and a third that matters more than both. The first is where the software runs. Some information cannot leave the building. Patient records, weapons systems. Palantir runs in the cloud, in a customer's own data center, or on a network with no outside connection at all, and has done since 2008. The second is what you hand over. How your business works is your edge. To be fair, both OpenAI and Anthropic say plainly they do not train on business customer data. The hesitation is structural. A company whose core business is a frontier model has different interests from one whose core business is your data layer. The third only makes sense once you know how this business earns. So go back to those engineers from the opening. They're called forward deployed engineers. And what they do inside those buildings is the whole answer. They learn how that organization actually works, including the parts nobody ever wrote down. Then they build alongside it. So the Ontology was never designed in an office. It is the residue of 20 years of that, inside organizations that look nothing like each other. A competitor can hire brilliant engineers tomorrow, and several just did. What it cannot hire is 20 years of having already been in the room, nor the clearances. Palantir's engineers work inside classified networks at defense and intelligence agencies on both sides of the Atlantic. A unit announced last quarter does not get that by writing a check, which leads to how this business actually makes money. Winning a new customer is the hard part. Building that foundation from nothing with engineers on site for months, slow and expensive. Then the easy part. Once the foundation exists, every new use case is built on top of it. Fast, cheap, and close to pure profit. So the first sale is painful and the next 20 are not. One figure shows this happening, and it is the most important number this company reports. Take every customer Palantir had a year ago. Ignore every new one it has won since. That group, on its own, spent 57% more this year than last. Not more customers. The same customers spending half again as much because the foundation was already there. One number, and it is the whole business model. So why can all that money not simply win? They can build one. Of course they can. $2.5 billion builds anything. The problem is replacing one that is already there. Think about what that foundation turns into after a few years. Every report the company runs comes off it. Every automatic decision reads from it. Finance says customer, the warehouse says customer, and they finally mean the same customer. So swapping it out is not swapping software. It is sitting down and deciding all over again what your own company means by an order, and a customer, and a territory. Everything, while the business keeps running on the old one. Then, after all that, what have you got? Exactly what you had before. From somebody else. Years of work to end up where you started. Nobody signs that off. Least of all the person who approved the first one. So all that money is chasing the customers Palantir has not won yet. Not the ones it already has. And the ones it already has are where nearly all the growth comes from. Now the part that cuts the other way. If those units take the customers Palantir has not reached, the base it grows inside stops getting bigger. That will not show up in revenue for years. It shows up in new customer numbers first. That covers the customers Palantir already has. It says nothing about the ones nobody has won yet. And that fight is real. Palantir does not walk into it clean. Microsoft can put this in front of every company that already buys from Microsoft, which is most of them. That is a distribution advantage Palantir cannot match. And it is the single strongest card any of these new units holds. But Palantir brings three things to a new deal that a unit launched last quarter does not. The first is proof. Live systems running at scale that a buyer can go and look at. The new units have slides. The second is the library. Every deployment Palantir finishes gets turned into templates for the next customer in that industry. Win a bank, and the next bank is faster. That compounding works on winning customers, not just growing them. The third is the part nobody can bid against. Cleared engineers, classified networks. A large slice of the work Palantir wins, the others are not allowed to compete for. So the honest split is this. On the customers it already has, Palantir is close to untouchable. On the ones it does not, it is in a fight, and it will not win all of them. Which is exactly why new customer numbers are the thing to watch. But that same motion is also what limits it. Landing a customer needs those engineers. Software copies for free. People do not. So how many customers it can take on in a year is capped by how many engineers it can train and send out. But templates only go so far. Translating what one company means by an order is still done by hand. So the growth rate this whole video rests on is limited by hiring, not demand. Which makes one thing the chief executive said worth holding on to. The stated goal is roughly 10 times the revenue with fewer people than today. If that happens, it breaks both ceilings at once. More revenue per engineer lifts growth, a shrinking headcount lifts margin. Treat it as an ambition, not a result. So look at whether that pull shows up in the results, and at the shape of the growth rather than its size. In 2024, revenue grew about 30%. In 2025, about 56%. Over the last 12 months, about 79%. Last quarter, 93%. Read those in order. Not just growing fast, still speeding up at a size where almost nothing speeds up. Work already sold and waiting reached $13 billion, up 83%. And it is profitable, with profit growing several times faster than revenue. Those are the numbers a business produces after it finds its fit. Not a company persuading customers, a company being pulled. So now the arithmetic is worth doing, because now there is a reason behind the growth rate rather than a hope. Go back to that number from the opening. About 150 times earnings. Now freeze the share price. Do not let it move at all, and let profit grow underneath it. Start with the base case. 60% growth a year, the middle of the band. Here is why 60 is fair rather than hopeful. Revenue grew 93% last quarter. Guidance for this year is roughly 80%. 60 sits below both. One thing to be straight about, those are revenue figures, and this arithmetic is about profit. Profit here grows faster than revenue, so using the revenue rate is the cautious choice, not a generous one. Hold 60% for 3 years and profit is about 4 times what it is now. So the frozen share price is no longer 150 times profit. It is about 37. Then the only other number that matters, what buyers pay at the end. There is a rough rule. A company growing at 45% a year is fairly priced at about 45 times profit. Growth and multiple travel together. So the base case exits at 45. Against a frozen multiple of 37, that is a return of about 1.2 times. Say that out loud, because it is not what a bull case usually sounds like. 3 years, 60% compound growth every one of them, and the stock rises about 20% in total. 6.4% a year. Now run the same machine twice more. The bear case, 50% growth, exits at 40. That returns 0.9. It loses money. About minus 4% a year from a company compounding at 50%. The bull case, 75%, exits at 50. 1.75 times, or roughly 20% a year. So the honest 3-year answer runs from losing 4% a year to making 20, which is roughly what an index fund does for a great deal more worry. So here's the whole thing in one picture. Same company, same filing, same day, in every line. Only the growth rate changes. Over 3 years, every $100 becomes about 88 on the bear case, 120 on the middle, 175 on the bull. That is the entire disagreement about this stock sitting in one row. You are not picking a company. You are picking a growth rate. So here are 3 things to watch, all published every quarter. First, that spending figure from existing customers, reported as 157 because they count the original 102. The alarm is not a drop below 150, which happens naturally as the base grows. It is a fall under 120. Second, new customers added, where the competition shows up first. American commercial customers grew 35% over the year, but only 6% over the quarter. That gap is the one to watch. Third, revenue against headcount. If revenue climbs while headcount stays flat, the machine is working. If they rise together, this is still being done by people. Everything before the arithmetic said this company is exceptional. The arithmetic says you are already paying for it. The run from $8 to $200 was the market working that out, and you are not early to it. Which is exactly what a great company at a fair price looks like from the inside. And that number from the opening, the 150 times earnings, it was never a fact about this company. This analysis staked 50 to 75% over 3 years. Last quarter came in at 93. Put your own growth rate in the comments below. If watching that get built step by step was useful, subscribe. One last thing, the content in this video is for reference only and does not constitute investment advice. All investments carry risk. Please make your own judgment based on your personal circumstances.